Oh, there you go. All right. Today's class is going to be on options fundamentals, and just want to give you a little bit of kind of a ground rules as to how I'm going to go over this and what you can kind of expect from the class. What I'm going to try to do, and this is partially for the people who can attend the class this afternoon, is go through the class front to back. And as I do that, I'm just going to be going through the presentation, explaining the slides, explaining the concepts that we're dealing with, and we're going to be recording this for everybody who can't be here at this session. So later on tonight at 7 o'clock Eastern Time, 9 o'clock Eastern Time, we're going to be replaying this session, and anybody who watches this can also get a recording of this, an archived version of it. But to make that work, I'm going to go through the session and then ask you to hold off on your questions until the very end. At that point, we will go over all the questions. It'll take time and try to explain some of the concepts better and just kind of give you a little bit more in-depth or give you a chance to go over the things a little bit more. Hopefully get something out of this class. Now, just to set your expectations straight, this is a options fundamentals class. Now, this isn't a purely beginner introduction to options. I'm going to go into some fairly deep stuff on, but we are going to be just talking about concepts. The goal is to introduce everybody to some of the fundamental reasons why options work and how options work. So we're not going to get into a lot of specific trades during this class, but understanding this stuff will help you very, very much later on when we're dealing with specific trades. Now, okay, Doug, if you wanted to start the recording, I'll get going at this point. So welcome everyone to the Options Fundamental class. Now, for some of the brief legal stuff, just need to remind everybody that ProEdge Trading Group is a community of traders who are seeking to educate and inform other traders about strategies, tactics, risks, and possible opportunities in options trading. All the topics discussed are the opinions of the presenters and are given for educational purposes. We're not financial advisors or registered brokers, and please don't take anything that we're saying here as specific advice to buy or sell securities of any type. As everybody knows, options trading can be complex and risky, so practice any concepts discussed using paper trading accounts, and please consult a registered broker or financial advisor before placing any trades with real money. And as we always say, past performance, whether actual or indicated by historical tested strategies, is no guarantee of future performance or success. So hopefully the lawyers will be happy with that. Now, in this class, we're going to be going over the basic concepts behind options. Specifically, we're going to be trying to answer a couple of very simple questions. What are options? What determines their price? How can they be traded effectively? And how can they be traded effectively? The goal of the class is to help you understand the concepts of options better. So we're not going to be going into specific trades, and I'm not going to be focusing on specific trades. This is a very, very fundamentals-oriented class. Now, I'm going to start out with some very basic stuff, and I realize that most of you here are much more advanced traders than this. Bear with me. We're going to get into some good stuff too, but I want to bring some people along that maybe are new to options, and I want to get everybody on the same page when it comes to the concepts. Now, at the most basic level, what an option is a contract between two traders. One trader on one side wants to buy an option, and the other one wants to sell an option. And the agreement is to buy or sell a stock at a specific price at or before a specific point in time. Now, there's some variations on that, but that's the fundamental concept behind options. You're not actually buying you're not buying the underlying asset. You're buying the right to buy a stock at a specific price. So that makes the price of these things function a little bit differently than you normally expect for a stock. And we'll be getting into that in a second here. Buyer of the option pays for this right and the seller receives the money. Now, we can choose to be on either side of that transaction. We can sell an option, actually creating an option out of thin air, or we can buy an option, buying a long call or a long put. All of the options in the market are created by this type of transaction. And the resulting number of options contracts are called the open interest. They literally are keeping track of how many of these contracts between two people have been created in the market at any one time. So, and by the way, the open interest numbers are calculated every night. So the open interest isn't something that updates on a daily basis or intraday basis. Every night they calculate out how many transactions created new options and how many transactions essentially destroyed an option or negated an option. Calls are the right to buy a stock at a specific price. It's called the strike price. Puts are the right to sell a stock at a specific price. Now, options actually come in two different varieties. Technically, there's more than two, but there's two main ones that we'll probably be dealing with here. American-style options can be executed at any time during an option's life cycle. That means from the moment that I buy an option, and by the way, the only person who has a right to execute the option is the person who buys the option. Once I buy that contract, I have that right to execute it and demand my stock at the price that I have for a strike price. American-style options can be executed any time at all during the option's life. Now, there's some misconceptions about this too. The option does not need to be in the money for the person who holds the option to actually execute the option. Now, it's kind of silly for you to execute the option if the stock is, if the option is out of the money, because you're actually losing money by doing that, so you pretty much never see it happening. But technically it is possible. I could call my broker at any time. I may be stupid, but I could tell them execute the option at any point in time. Now, the other flavor of options is European-style options. And European-style options may only be executed at the expiration of the option. It's one moment in time. And typically those are automatically executed if they're in the money, if the option itself has value. And I'll get into the concepts behind that in a second. American-style options are the most common, and priced. This is also something that's interesting. American-style options are priced slightly higher due to the ability to execute them at any time. When you're dealing with options, we're dealing with the price of risk. And if one of the risks that I'm taking by selling you an option is that you can demand the stock at any point in time, that's a higher level of risk. Therefore, American-style options actually have a slightly higher price than European-style options. European-style options can often be found as index and futures options contracts. Let me see here. I may be getting this wrong, but SPX, I believe, is a European-style option. There's a handful of others. They're not as common, but they are out there. One thing you're going to want to do as you're trading options is make sure you know which one you've got, because if for some reason you do want to execute the option, if you want to demand delivery of your stock or demand delivery of the sale of your stock, and you have a European-style option, you're not going to be able to do it. 90% of the time, this is not going to be an issue, but just be aware that there are different styles. So know what you're buying, and as you're trading, just keep a general eye on what's going on. Most European-style options will be noted as European-style in your trading platforms. Now, the strike price of the stock, the strike price is the price of the stock that the buyer will pay if they choose to exercise the option. Now, in the case of a call option with a strike of 35, the buyer has the right to buy the stock from the seller at $35. So the buyer of the option has the right to demand that the seller of the option gives them the stock for $35. Pretty straightforward, pretty basic. If the stock price has gone above $35, then obviously that sounds like a really good deal. I can tell the other guy that this stock that's now trading for $37, I want him to sell it to me for 35 because he agreed to in the options contract. I make $2 out of the deal, and I walk away happy. At least if I didn't pay more than $2 for the option itself. So that's the concept of how the strike prices work. Now, if the stock price is less than the price, there's really no value. There's no intrinsic value to the option. We'll get into that in just a moment. And the same goes for puts. Now, puts are just the opposite direction. A call is the ability for me to buy a stock from a person at a specific strike price. A put is the ability for me to sell my stock to him at a specific price. So in the case of my stock and the put option of $35 strike, that means I have the right to sell my stock to another person at $35. If the price of the stock is below $35, then I'm made out on the deal because the price, it's working out in my favor. So when we're holding on to long puts, we want the stock price to go down. When we're holding on to long calls, we want the stock price to go up. Now, exercise, once again, is always the choice of the buyer. I mentioned that before. Okay, now let's get into some more interesting stuff. Like I said before, I just wanted to go over the very, very basics at first because, well, it's important to get on the same page, to have the same terminology, to understand where we're coming from. But the real thing that we want to understand is what makes up the price of an option. What is driving the price that you see on the screen of the option? Because if you don't know that, you can't really trade it. So let's go over the parts of the price of an option. First thing is what we call intrinsic value. Intrinsic value is the amount of money. Actually, it's actually two things. There's two pieces that count as what we call intrinsic value. It's the amount of money that the option is in the money. Now, what I mean by that, if I have a call option that has a $25 strike, and the stock is trading at $27, the price of that stock is $2 above where I could get it for based on my call option. That means that it's $2 in the money. I've got $2 of hard and fast value built into that option right now. So the price of the option should never go below its intrinsic value, that $2. If the stock is out of the money or at the money just means that the price of the stock is trading at almost exactly the same price as the option itself, or the strike itself. Out of the money means that it's trading below the strike price, so it doesn't have a lot of intrinsic value. Now, there's one other piece to intrinsic value that we really don't pay attention to very much, and there's no reason to pay a heck of a lot of attention to it right now because it's not a significant piece. That's time value. Now, if you're an options trader and you're very familiar with the Greeks, you've probably heard the term rho. Well, what rho is the time value of the money that the seller, the time value that the seller could have gotten on his money should he or they have done something else with their money instead of locking it up in selling you an options contract. Now, every time I sell an options contract, I've got to set aside margin. I've got to cover the risk of doing that. And that means that I no longer control that money. The value of that money is theoretically into a risk-free investment, treasury bills, government bonds, something along those lines. I could get maybe a fraction of a percent these days out of that money. Years and years ago, when inflation was really high, back in the 80s, when the interest rates were extremely high, rho actually was a significant portion of your trades. Someday it may be there again. I mean, the way we're going right now, it might be sometime soon. But right now, the time value of the trade is fairly insignificant. but I do want to mention it so that you get a clear picture of it. The amount of money that the stock is, that the option is in the money, plus the time value or the interest you would have made on the money should you have used it for something super safe like a T-bill, is the intrinsic value. If the stock is out of the money, there is no intrinsic value. Technically, there is a little bit of time value, but very, very small. Now, the second part of the option price, and this is far, far more interesting. In fact, this is what we're going to be working with mostly when we're trading options, is implied volatility. Now, if you really want to get down to it, implied volatility is just a nice, neat name for all of the leftover value in an option after you take out the explainable bits. I'm sure that a lot of you have heard of the Black-Scholes equations or the Black-Scholes formulas. Talks about implied volatility, theta, vega, gamma, all kinds of different factors of an options trade. Well, when you get right down to it, implied volatility is the entire value of the option outside of value. It's the leftover. It's the remainder of this. They've got some fancy formulas to explain what that is and to break it up into bits and to say this factor of it is this and this factor is that. But really what it is all the extra money. Now there's a good reason for that extra money. Nobody would get into this trading if there wasn't a way to make a profit, and implied volatility is basically the profit for the seller. So we'll take a look at that in a little more detail in a second. Now, what makes up the price of an option in the implied volatility? Number one aspect of it is risk. Every seller of options wants to make money. And to do that, they have to mark up the options. They can't sell it to you for exactly what the intrinsic value is. Why would I do that? I'm setting myself up to lose. I want to make money. I want to make a profit. And I want to protect myself against me being wrong. I believe that the stock is not going to go through the strike price, and it's not going to force me to sell you this stock at a certain price or buy your stock from you at a certain price. But the fact is, if I'm wrong, I need some money to make sure that I cover myself in case I am wrong. In fact, I need to make more money than the overall risk that I'm taking, or there's no sense at all of me to take the trade. So that's what we call the risk premium of the trade. And it's basically figuring out what's the chance of the stock price moving through the strike and creating a value on that says, even if this happens, I'm protected because I've made X amount of dollars. If a stock moves a lot and then moves around a lot, if the nature of the stock is that it's a very volatile stock, it goes up and down, or maybe shoots around a lot, then the option prices will typically be high. And that means that it's also got a high implied volatility. If the stock doesn't move much, if the stock is very stable and it's not going to shift around a lot, then the price of the option will be lower. The implied volatility will be very low. So that's the relationship between these. Because if a stock moves around a lot, then there's a higher probability that my strike price, whatever it happens to be, is going to get moved through, and I'm going to have to deliver the stock to somebody, or I'm going to have to buy the stock from somebody as a seller. That's something I don't want to do. As an option seller, I don't want to have the hassle. I don't want to have the risk. I don't want to have the financial liability of that. So I want to price my options when I'm selling them to make it worthwhile for me. Now, a few other things that affect the implied volatility. Anything that is going to potentially change the way the stock price moves, I have to take into account as the option seller. Now, let's be clear that the option sellers are really the people who are driving the pricing on the market. It's not as much of a double-sided market as you might think. The people who are selling options, who are literally creating these things out of thin air, are the ones who are pretty well deciding on the price. Now, one seller might get in front of another seller and have a slightly lower price, but it's almost always the sellers who are really determining where the price of the market is. Buyers do come along, or buyers can disappear, but the sellers are kind of the ones who set the standard for where the implied volatility is. Anytime you've got something that's coming up, earnings events, FDA announcements, maybe a major economic announcement, non-farm payroll, whatever, the things that are going to change the way that the market is moving, change the way that the stock price is going to move, those sellers of the options are going to want to protect themselves. They're going to want to back off from the price. They're going to want to raise their price up so that if somebody does want to buy one of their options, if they want to create an option, they're going to pay dearly for it, and the seller of the option is protected. So that's the mentality of the people who are selling these things. Gives you a little sense of how the price is formed in the market. Now, so when you get right down to it, implied volatility is a combination of about three different things. One is the measured probability of the option going in the money. And this is something that's actually measurable. I mean, it's something that's estimatable. I can go and I can look at the way a stock moves, and I can run it through some equations, and I can tell me, what does this normally do on an annual basis? What's the chance of it going up? Or what's a one standard deviation movement up? What's a one standard deviation movement down? Things are actually measurable components of the options price. The next piece that goes into the pricing of an option is the fear, uncertainty, and doubts of the option writer. The more uncertainty in the market, the higher the implied volatility is going to be. I'm talking across the whole market. I'm not talking about one person who's particularly a worrywart or something like that. I'm talking about everybody who's writing options is looking at the fact that stock XYZ is going to have an earnings announcement on Friday. If I write an option on stock XYZ, I want to know that I'm going to get enough money to make it worth my while, so that this risk that I'm taking by writing this option is not outlandish. So I know that the market can rapidly change XYZ's price because of an earnings announcement. Therefore, I've got a lot of fear, uncertainty, and doubt. What's going to happen with this? There's no confidence that the stock price is going to stay stable, go up, or go down. Therefore, I'm going to increase the implied volatility. I'm going to increase the price that I'm selling this option at. So that is an increase in implied volatility. That's another aspect of the price. Above and beyond those first two things, every single person who's selling options has a motivation to make profit, and they're going to make as much profit as they possibly can. Now, it's our job to not let them. It's our job to figure out the situations where we can get in front of them, where we can find a deal that's better, or find them in a situation where they've got to get rid of their positions and they're driving the implied volatility down, and maybe we can play off of that. But every person who's trading in the market has a profit motive. There's nothing noble about the markets. You may consider markets themselves to be noble, but the fact is that everybody has agreed motivation. And that's actually what makes the markets work. So I'm not against it in any way. I personally like the whole process. But anybody who's writing options, once again, they're the ones who are really creating the price, is going to want to make some money. So above and beyond the amount of probability that the option is, or the stock is going to go in the money, above and beyond the fear and the uncertainty and doubt of the option writer, they're going to add on a little bit extra so that they know they're making some money on this trade. So those are the three things that drive the price of an option. Now, when we're trading, we need to keep these in mind, because we have to see when the options prices are shifting around in our favor so that we can play off of this. If the price of an option is very, very high, the implied volatility is very, very high, and we want to take advantage of, say, a stock going up. If the implied volatility is too high, we may not want to play with that, because we may not be able to make a profit on the trade after we pay for the option. On the other hand, we might be able to flip the trade over and create a credit trade, a bull put spread, that does actually allow us to make some money on the options. We need to understand how these things relate to each other so we can make good decisions about those things. Now, one of the things that we talk about a lot is what's the actual probability of the price movement. Now, I'm not going to get into a whole discussion on expectancy, log normal distributions, things along those lines, but I do want to just touch on the concept so that we can understand it at least in concept. One of the things that typically creates a minimum price for the implied volatility or the price of the option is the historical volatility, or the probability of the price moving through the stock. Now, when we're looking at probabilities, and I'm not going to get deep into probabilities, don't worry, I'm not going to start doing a bunch of calculations here, but when we're looking at probabilities, we're looking at what's called a log normal distribution. This is kind of the standard distribution model that, or probability model that they use in the markets. Is it perfect? No. Does it have some problems? Absolutely. Is it the best that they've got at the moment? Yes. So that's what they use it. That's what they use. All of the formulas that you would typically use to figure out things like deltas and implied volatility, Vegas sensitivities, theta sensitivities, things along those lines are all based off of a log normal distribution. Now, a log normal distribution basically just gives us this bell curve formation and says that based on the price movement of the stock historically, this is the chance that this price is going to get hit over this period of time, or it's going to end at this price at this period of time. Now, some stocks don't have a lot of volatility in them. They've got a very, very tight range. They might move 0.2%, 0.3% in a day, might go up 0.1%, then go down 0.2% the next day. Very, very small price movements. In that case, we've got a stock that typically has a low historical volatility. If a stock has a low historical volatility, we can generally assume that going forward, that's not going to change radically. Now, as a general thing a general assumption in the stock market that if a stock price moves in a certain way, unless there's something that changes the way it moves, it's going to probably keep moving that way. Now, I'm not talking about trend lines or anything like that. I'm just talking about pure volatility. If a stock that goes up 0.5%, down 0.25%, up 0.33% is not likely to change the way it moves and suddenly jump up 3% one day unless there's a reason. Now, the reason may be hidden from us. The reason might be some hedge fund just wants to load up on a huge amount of the stock, but there's a reason. Otherwise, it will just kind of stay the same. What that means is that once we understand how a stock moves, we can actually take a look at the volatility, predict a little bit out into the future, and say that unless something comes along to change this, it's probably going to be the same, and therefore the forecast volatility is this. In other classes, we go very deep into forecast volatility. In a lot of our trading models, we use forecast volatility. So I'm not going to dive into that too deep here. Honestly, that would practically take an entire class in and of itself. But one of the key pieces is to understand how you think that the stock is going to move. Now, if a stock normally moves great big movements each day, that means that we've got high volatility. If it moves very small movements each day, it means low volatility. Now, that was talking about historical volatility and forecast volatility. Theoretically, if you talk about efficient markets, then implied volatility shouldn't be terribly much higher than forecast volatility. In fact, it should almost never get lower than forecast volatility. The two should be tied very, very closely to each other. Fact is, that's not exactly what happens. In fact, more often than not, it isn't what happens. There's a lot of reasons why market makers, floor brokers, the big options trading houses might change their prices away from what should be a standard price for volatility. And that can be a lot of things. But the key thing to think about here is that implied volatility can be overpriced or it can be underpriced. Now, it's more often than not overpriced. I'd say that 80 to 90% of the time in the market, implied volatility is overpriced. But there are moments in time where it can be underpriced, and recognizing that fact is a critical thing because it can really drive how you trade. Now, a couple of reasons why implied volatility might shift. Every one of the people trading options, every one of the people creating these options, selling them, has a certain amount of limitations. And they might have $50 million that they can put into an options portfolio that they're managing. And most of these are writing options and then buying some options to kind of offset different risks. There are times when option writers, the floor brokers, the market makers, these big trading houses, have just written too many options. And they don't want to take any more. But they don't necessarily want to back off from the market completely. They know that if somebody is willing to fill them at an outrageous price, then they'll take the trade. So what they do is they increase the price of their options. They raise the price that they're willing to sell them at. Now, as long as somebody else is not full up, there's somebody below them that's going to take on some of the trades. But there are times in the market where there aren't that many people. I mean, the options market is not as deep as, say, the equities market. There isn't 1,000 people on the other side of the trade. There's literally sometimes a handful of people who are writing these options at any one moment at least. And at some point, they just don't want to take on any more risk. So the price of the options gets high. In those situations, you can actually get an advantage in the trade or getting an advantage in the market by stepping in front of them and writing the options in front of them. You now become the market maker. You now become the floor broker. You're supplying the liquidity for the options. You're selling it. You're taking on a risk, but hopefully what you're doing is you've got a situation where you can take on a risk for a very, very high reward. Other things to think about. Rumors or other vague risks very, very often drive implied volatility up. It's a great quote that implied volatility is driven by what might happen, not by what's likely to happen. Anytime there's some kind of vague risk or crazy rumor, you're going to see implied volatility jump up. Because the people selling options know that as soon as that vague risk gets out there, somebody's going to get panicky on the other side and they're going to want to buy protection. And that's what they're selling. Implied volatility options are selling protection to people. So they raise their price knowing that there's going to be customers. Another thing to think about, one of the major drivers of pricing on options is large funds. Hedge funds and certain styles of mutual funds are allowed to take and use, well, hedge funds definitely, they're allowed to use options to offset risk in their positions. Now, there's a really interesting kind of effect in the market when it comes to hedge funds. And I've talked about this before, and I'm sure I'll say it again. But hedge funds are not motivated to make profits the way people think they are. Yes, hedge funds want to make profits. They want to make money. They want to impress their customers. But more than that, a hedge fund can make their customers a huge amount of money, and they participate in a little bit of that. But more than that, they want to have a large amount of money under management. And to do that, they need to be stable and they need to eliminate risks. They will not get more customers by taking a big risk and making a big, huge win than they'll lose by taking a big risk and taking a medium loss. They know this. I've got friends in the industry, and we've talked about it. They're far more worried about not taking a loss than they are about making money. So to protect themselves as they make money, what they'll do is they'll take some of that money that they make, turn around and buy puts. Now these are big, big, big players, and they're sometimes moving around literally billions and billions of dollars in equities. And to protect that, they're buying a lot of put contracts. As they go into the market and buy up these put contracts, the people who are selling them, are building up portfolios until they're getting so full they don't want to take anymore, and they start backing off. That effect right there, these hedge funds coming in to protect themselves, and the sellers of the options getting basically more, selling more options than they really want, causes the implied volatility of the option series to go up. The flip side of that, sometimes options traders just want to reduce their positions. So they might take a bunch of the options that they're short on and buy to cover. They might want to just offset positions. A lot of different motivations can be there to move the implied volatility around. So, or they might want to build up very rapidly. They might have some kind of understanding of the market that we don't have. Not really sure whether it's inside information or whether it's just good analysis, but they may want to build up short positions. They might want to build up long positions. They might want to just offset and hedge different options that they've already got. So there's lots of things that can cause the buying and the selling of the options to shift around a lot, and implied volatility to shift around a lot too. Watch it. Pay attention to what's happening in the options market, because there's a lot of really, really interesting things that you can see. And when you understand them and you can catch what's going on, you can use it to make some money. Understanding the options and implied volatility is going to give you an edge in your anything you do. One of the things I want to get across in this particular session is that when you're trading options, you're not trading the direction of a stock. You're trading the chance of the stock moving in a direction. There's a difference. I'm going to get a slide in the future here that will talk about that, so I don't want to jump ahead too much. But focusing on implied volatility is probably one of the greatest things to give you an edge in your trading. So think about it a lot, follow it, learn to read it. Now, here's a couple of things that I've seen over the years that it can give you a little edge. And these are just strange little effects that implied volatility have on the market, or effects that shift implied volatility around. And when you start thinking about them, they make sense. Implied volatility is often slightly higher right after the open of the market. First 15, 20 minutes of the day, there's a lot of transactions going around. The people who are selling options are not necessarily going to throw out their best price of the day right in the first thing in the morning. They're going to hold back, see where things are going. They're not entirely sure where the market's going that day. They don't have a feel for it yet. So the implied volatility in the first 15, 20, 30 minutes of the day can be high. Why is that important to know? Well, if you're doing things like iron condors or credit spreads, that's probably one of the best times of the day to actually take the trade. If you don't know which direction the market's going in, if you don't have a sense as to where it's going to go, then that first 15, 20 minutes means that you can participate in this high implied volatility right along the market makers. Something to think about. Implied volatility tends to be very high the first day or two after a new options contract is created. Because remember, every couple of months they're putting out brand new options contracts. They're basically setting up an options contract to expire 3 months from now. So a brand new options contract becomes tradable on a certain day. Now the first couple of days the liquidity is not that high, but what's happening is these hedge funds that are trying to protect themselves, they're trying to hedge off their risk, are diving into those options, those brand new options, because they've got the longest amount of time before they expire, and that's what they want. They're actually trying to get the most protection for the least amount of money. So you get all these people diving in. The people who sell the options know that. They've got the high implied volatility, the high price, and it's just something that you can work with also. So there's actually trades that you can do that literally create short volatility positions in the first day or two of a brand new options life, and then a few days later you close it out and you've made a little bit of money because the implied volatility has dropped. On weekly options, they're very common for the implied volatility to drop quickly on Fridays to pre-price in the time erosion of the weekends. There's a lot of focus on weekly options, and people have been trying to get that really, really high theta erosion, the time decay of the options. What happens is that actually reduces the implied volatility overall in the options, and it kind of pre-prices in the time decay of the option over the weekend. Another thing you can pay attention to. So sometimes on a Friday, midday, mid-afternoon, you can actually pick up some options fairly cheap, which is the opposite of what we a lot of times are doing. Right after major gaps, actually after any kind of major announcement, anything that's going to radically affect the way a stock price moves, the implied volatility will be very, very high for a short period of time. You can sometimes do some very short-term trades on these. Once again, you create a short volatility position and wait for the implied volatility to die out, get back down to a normal, reasonable level, and boom, you've made your profit. Another thing, on expiration Friday, the implied volatility of future months contracts will get inflated due to what we call a rolling effect. Once again, this is looking back at those hedge funds. They've got their protection that they bought maybe 3 months ago, maybe 2 months ago, whatever. And they know that it's expiring right now, that on Monday they're not going to have the protection that they had today. So what they need to do is they need to get out of the contracts that they're in, and they need to buy the next month. They need to put that investment in. A lot of people buying options drives the implied volatility up. So if you're looking to create short implied volatility trades, iron condors, credit spreads, things along those lines, options expiration Friday is a great day to do it. You can actually get some extra implied volatility built right into the trade. So let's keep that in mind. So just some thoughts on implied volatility. It's an extremely important aspect of the options. So these are the things that I want people to be looking for. If you can find those little edges, we've got all kinds of reasons to take trades. These things probably won't be trades in and of themselves, but they can really affect when you place a trade and how you place a trade. I love doing iron condors on options expiration Friday because I almost always wake up on Monday morning with a little bit of profit in my pocket. The implied volatility was high on Friday, it dropped down to Monday. Didn't necessarily change the trade I'm taking, but it certainly affected my timing of when I'm putting it on. I'm getting an extra edge because I'm following along to what's happening in the market. Now, the other piece of options pricing that's extremely important, and I've gone on and on and on about implied volatility, is time to expiration. This is theta. This is the amount of time that an option has in its life. So if the risk determines the implied volatility of an option and is one of the biggest components of the price, the time to expiration tells us how long we'll be exposed to that level of risk. And the less amount of time that you're exposed to a risk, the less amount that or less price that the option is worth. Options are less valuable the shorter they have to live. If I've got an option with a strike price of 35 and the current price of the stock is 32, it means it's got to move $3. If I've only got 2 days for that to happen, then probably it isn't going to happen. There's a low level of risk of that happening, or a low level of opportunity from my point of view. And the option price is going to be very low. If I've got a month and a half and it needs to move $3, then there's a very good chance that that could happen. There's plenty of time for it to happen. Therefore, the option price is higher. So basically talking about this again, as we get closer to the expiration of the option, there's less time for the stock price to move and the risk to materialize in the market. Therefore, the option price goes down as we get closer to expiration. Term for this is theta erosion, or time decay, whatever you want to call it. But technical term is theta erosion. The theta value on an option actually is one of the Greeks, and it tells you how much you're going to lose each day as you get closer and closer to the option's expiration. Now, one of the important things to understand about how the theta affects the price of an option is that it accelerates. Each day, not only does the price of the option go down, but the rate at which the price of the option goes down increases. It gets faster and faster and faster and faster. So one of the things that we do to kind of take that into account is we actually use that theta erosion in our trades in certain ways. This information right here is literally the reason why iron condors are typically done with an expiration of about 20 days to about 35 days out, or about 20 to 40 days out to the option's expiration, because we want to try to get that rapid decay of price right at the end. It's going to give us our highest return for the amount of time that we're holding on to the position. Just something to know. If you're ever holding on to an option, if you're holding on to a long option, you want to be as far away from the option's expiration as you possibly can get. That's because the theta erosion that you've got to deal with every day, the value of your trade going down, goes down less since you're further away from the option's expiration. If you're holding a short position, if you've sold an option, then you want to be as close to expiration as possible, because the erosion of that price is getting faster and faster and faster as it gets close. All right, so quick review. Go over some of the stuff here. The price of an option is made up from the following factors. You've got your intrinsic value, the amount that an option is in the money plus a small time premium. You've got your extrinsic value, the option of the value representing risk plus the fear, the uncertainty, and the doubt, plus the profit. It's known as implied volatility. And the extrinsic value is reduced as the option gets closer and closer to expiration, and that's theta erosion. So those three things, if you can work on understanding how those work together, are what really drive the price of an option. And as we get more and more into different styles of trades, we'll show you how to basically use those factors to your advantage. And really understanding these at a fundamental level makes options trading so much easier, because that's what we're trading. These are the factors we're trading. Now, what are we trading? When we trade stocks, we're basically trading the change in the price of the stock itself. $1 up or $1 down effectively equals $1 profit or loss to us. Obviously, that's not taking into account margin or leverage or anything like that, but the concept is pretty simple. There's a one-to-one relationship between what we're trading, the price, and what, the price of the stock and the value of the trade. When we trade options, it becomes different. These are derivatives. These are a step away from the actual underlying. We're trading the chance of a price movement happening versus the price we pay to take that chance. Now, I actually know that that's confusing. I'm sorry. I'll get into that a little bit more. But think about that. When we buy an option, we're making a bet that something is going to happen. There's a probability that it's going to happen. If there's a high probability that it's going to happen and we pay a low price, that's a really, really good bet. If there's a low probability of it happening and we pay a high price, it's a bad bet. And that's one of the things that we need to understand, because that's fundamentally what you're trading every single time you trade an option. Now, you may have lots of reasons to take the trade, and you might be trying to capture something, a trade idea that isn't necessarily a chance of this moving and a chance of that moving. But when you start looking at the pricing of the options, the implied volatility, the intrinsic value, extrinsic value, and the underlying price all together, you come down to the same thing every time. What's the chance of a price movement happening versus what do you have to pay to take advantage of that? Now, you could flip that on its head and say, I want to get paid a lot to sell you an option that actually has very low risk to me. Or you could be the buyer and say, I'm going to buy this option and I want to pay as little as possible to get a high probability of a price movement. So When we buy a call option, we're paying for the right to buy a stock at a strike price because you believe the stock will go up past that price. There's a probability that it will. I mean, whether or not you're thinking in terms of probabilities or not, it is a probability that it will. The seller's calculating the chances that you're right and then charging you a premium to protect himself in case you are. Now, this is the profit in the trade. Now, think about that process. He's basically pre-charging you for the price movement that he expects to actually happen in the stock. So it doesn't necessarily matter for them whether or not the stock price goes up or not. It's whether or not it goes up past the point where they've lost money. And they're doing a very good job at calculating that. If you get the trade cheaper than the actual price movement, you're the winner. If you pay more for the option than the price moves, they win. So pretty basic stuff there. Now, I'm going to do a really simple analysis here, and this isn't perfect. This is just to point out some factors in the trade and things like that. But I want to show you what happens based on the implied volatility and the premium of the stock. Now, we're analyzing a simple call option bought 45 days from expiration. The current price of the stock is $98. The strike price of the call, and we're buying a long call, is $100. The price of the stock moves as expected to $105 over the life of the option. Okay, sounds like a pretty straightforward trade. I'm buying a long call. The price moves up past my strike. It's starting to build up intrinsic value. It's moving up to 105. If I held that all the way to the expiration, I'm going to have a call option that's worth $5. Now, we start out and we're looking at this. Now, understand, I don't know exactly, oops, excuse me. This analysis was actually to 104. Same concept. I apologize, I typed in the wrong number there. Now, when I'm putting this trade on, my guess is that the market's going to go up. And I have a general idea if it's going to go up to roughly this amount. Could go up more, could go up less. The reality of the situation is it moved up to $104. The implied volatility on the trade, on the options, when I bought them, 45 days out, was 30%. That ended up being a call price of $3.23. So to get into this trade, we just spent $3.23. The stock price moves, and everything goes along as we expected it. And a lot of times when I'm talking to newer options traders, this is something that catches them by surprise. They don't understand what happens here. In this case, everything went great. The trade turned out very, very well. And that's because the implied volatility was actually less than the price movement of the stock itself. The 30% implied volatility didn't cover the seller of the option for the risk that they took, and they ended up losing on it. The entry price was $3.23. The exit price was $4. The person who bought the option was the winner in that particular case. And in fact, they made, what was it, 20-some odd percent. Not a bad trade. Now, this right here, the blue, is the line of the stock price movement. Now, the interesting thing here is that this red line is the return on each of these days of this trade. Now, it is going up, but it isn't going up in a straight line. And it really, we start to get this time erosion that starts hurting this thing. It's actually not rising as quickly. And then finally, everything that's going into the price of the stock or the option is intrinsic value. It starts shooting up. Now let's take a look at this as if we did a bad decision. This is the exact same trade. Same situation, same scenario, same going up from $98 to $104. Except in this case, when we bought the long call, the implied volatility on that long call was 45%. Now, I realize that if you were expecting it to go up to $104, you probably wouldn't have taken this trade. But I wanted to show you something, that of how the price actually moves, how the option actually moves in value as we get closer and closer to the expiration. So we spent we basically bought this option at 45% implied volatility. Had an entry price in this case of $5.28, much more expensive than the last one. Remember, this is the exact same option that we were buying, it's just different implied volatility. So when we got into this, we spent $5.28. The stock price moved in exactly the same way, and the return on the trade, though, didn't move the same way. Since we spent $5.28, the erosion of the theta erosion of this trade took over. We were losing more each day than the option was gaining in value. So the value of this trade goes down and down and down and down until actually the very last couple of days, the intrinsic value starts taking over a little bit more. There's not much theta erosion left on it, and boom, we have a little pop. But we still end up with a 25% loss. So you can see where the same trade, the same assumptions, but different implied volatility changes the way the trade works entirely. You know, I'm giving you some very simplistic examples here because I want people to clearly see the concept and to think about it. Now, a savvy trader probably would have analyzed this and probably wouldn't have taken this second trade. But it's amazing how often people just think about the price movement. You'd think that if we bought a long call, a price movement from $98 up to $104 would make you money. I mean, without actually taking a deep look at it, just buying it really quick, that makes sense. But the fact is that the implied volatility was priced higher than that. This price movement was not worth 45% implied volatility. So we just overpaid for an option. And technically we were completely right, and we still lost money. So that's why paying very close attention to implied volatility is critical on our trades. And that's why understanding how implied volatility works in the options is critical to the trades. Now, I'm going to go into a little bit more of a real-life example, and I'm going to play around with a couple of different things. This is kind of wrapping it up. Mainly what I'm doing here is just showing you some examples of how we can play with different styles of trades to take advantage of the exact same concept. We're looking in this case at a stock XYZ. It's trading at $29.17. I literally took this from the market just a couple minutes ago. These numbers are all live numbers. And I just used XYZ because I don't want people focusing on the stock. I want people focusing on the concept. It has an average implied volatility right now of 35%. Our expectation is that the price of the stock is going to rise towards $32 between now and the May option expiration. Now, this is an important thing. Its historical volatility is 15%. So we've got a pretty big discrepancy between the 35% implied volatility and the 15% historical volatility. Now, these are live numbers. This is not made up. These are directly pulled from the market. These are things that happen quite often. Now, here's the chart. Once again, I cut off the name so we don't focus on the symbol itself. But it's going down and up and down and up. And for some particular reason, I believe that this particular symbol is going to go up to close to $32 between now and May 18th, which is the May options expiration. Well, let me see here. I'm actually going to pull up a spreadsheet. I did a couple of scenarios, and I ran this in different ways. Now, I don't want people focusing on whether or not the scenarios themselves are great trades or bad trades. I want people looking at what are the different options, what are the different styles of trades that we could take to take advantage of this situation. And I'm also going to point out something, the expectancy of the trades and the different scenarios that we took. So let's see. All right. First of all, I did this out as an extremely basic long call. I used a $30 strike. The current price of the stock is $29.17. The margin number on there is wrong. The margin actually on this trade for 10 contracts is $1,050. It's going to cost me $105 per contract. So based on that, I've got this profit potential of this. You can see the blue line. This is a very standard chart for a very standard chart for a long call. This red line represents where the stock price is and what's the probability of the stock price hitting one of these levels at some point in the future. Now, I actually have a spreadsheet that I'm going to flip over to. Okay. Hold on here. Okay, this is a spreadsheet that I use for analyzing trades. As a matter of fact, it's brand new. I'm getting ready to release it. Some of the people might have this already, but I'll be releasing it to people in the class and members of ProEdge in the next probably week or so. Anybody who wants a copy can have one. And it's basically showing me the probabilities of the trade working out as I expected, purely based on the forecast volatility. Now, I may have other reasons that I believe that the stock is going to move in a certain direction, but one of the things we really want to look at is the forecast volatility. Okay. Hold on here. Okay. Now, if everything works out exactly as I planned, then the profit at $32 for our, let's see, oops, sorry, there's a slight difference in the pricing here between the slides and this. Our trade cost was $1.58, making the total extended value of this trade, the cost of this long call position, this is 10 long calls, is $1,580. If the trade works out exactly as we thought, and we come out at $32 on May 18th, the expiration of the May options contracts, this trade makes $1,420. That's great. That would be a great trade. I would call that a home run. The problem is, if we're wrong and it doesn't work out, we just significantly overpaid for this position. As a matter of fact, the expectancy, and the expectancy is just calculated out from what's the probability of any one of these points being hit, versus the actual payout on the trade, shows me losing 54% on this thing. What just happened there? Now, if we're perfect and we're absolutely the best traders in the world and we know exactly what's going to happen, then this might be a great trade. I'm not saying that a long call is not a bad trade if you choose the right timing and the right prices and the right levels. But it's really hard to do that all the time. And since the implied volatility on this particular trade, in this particular case, the strike that I bought was implied volatility of 39%. I significantly overpaid for this long call. Now, once again, it doesn't mean we won't win. If we do hit $32, we're going to make $1,420. Great. But if we don't hit $32, this thing's not really a good trade. In fact, it's a bad trade. On average, the expectancy, if you calculate out all the probabilities, is we lose on this more often than not. Now, taking a look at this from the point of view of implied volatility, what made up the prices? I can say that overall the implied volatility in this particular stock is fairly overpriced. In fact, let me just jump back here. This blue line on the chart is the implied volatility. The red line is the historical volatility. Now, I've got a little bit of special formulas, but the fact is almost anyone's platform should be able to tell them one version of historical volatility or another. There's nothing magical about one that makes one analysis better than the other. I just have this one because I like it, that it takes out gaps in the market and it doesn't shoot all over the place if there's a gap down. But what it tells me is that overall, on an annual basis, this stock is going to move 14% up or 14% down at one standard deviation over 1 year. This implied volatility is telling me the exact same thing. It's telling me that the risk I'm paying for, or the amount of movement that I'm paying for, is 35% up or down over a 1 year period. That's one standard deviation movement up or down would be 35% move. So I am way overpaying for any long position here. All right, that's reasonable. I know that now. Let's start shifting this thing around. I want to take this as a slightly different trade. I'm going to take a bull put spread. Now, once again, please don't analyze whether this is the perfect placement of a bull put or not. I'm just really trying to show off the concepts here. So I'm going to create a bull put, basically a combination of a short put and a long put. Now, what this does is, since I'm shorting one side and going long on the other side, I am basically negating the fact that I'm paying extra, or that the implied volatility is high. In fact, I'm getting an advantage out of that. I'm actually receiving extra. I'm receiving extra money because the implied volatility is high. So I'm getting a credit on this particular trade of, let me see here, $930. Now, the $930 defines how much I'm going to win off of this trade. And I'm also sitting here with a margin of $2,020. This is going to cost me more, and I'm not going to make as much. But the nice thing about this is, by lining up with the way the implied volatility is biased in the trade, we've got too much implied volatility compared to the real price movement of the stock. I actually created a situation where the probability of me winning is much, much higher. If the market played out in a random fashion and I was wrong and my stock price didn't move up or down, let's just say it sat there or it went down a little bit, overall, this trade is going to make me 24% on average, whereas the last trade, the long call, was going to lose me 50% on average. Now, we're going to have another class in the future that's going to go over expectancy. It's a complicated subject. Probably want to take some good time on it. I can't go into the details today. But at this point, just at least take it on faith that it gives us the ability to compare one trade to another. Now, once I put on a bull put spread, there's another trick we can do. And this is going one step further into our trading. Bull put spreads basically are giving us a credit saying that the stock is not going to go down below a certain amount. Well, that's good. But we also have the ability to take the other side of that trade and say it's not going to go above a certain amount. We can create an iron condor. So the iron condor, we widen out the spreads just a little bit, or widen out the strikes just a little bit. In this case, I put a short put at 28. I put a long put at 25. Did a short call at 31. And a long call at 34. Created a trade that ended up having a margin of $1,710, less than the bull put spread, and ended up giving me a credit of $1,290. Now, the great thing about this is I actually have a probability of making nearly 61% on this trade. Now, for those of you who trade iron condors, this is probably an extremely aggressive iron condor. I literally laid this out quickly so that I could illustrate the concept. But we're taking roughly the same trade, roughly the same stock, roughly the same situation, and just shifting around the strikes that we use, shifting around the options we use, shifting around the way we construct a trade, and really lining it up with the implied volatility and the probabilities of success, and creating a trade that can make a lot more money for us. Now, does expectancy of 61% tell me I'm going to make 61% this time? No. But if my assumptions are correct, and if my analysis of the situation is correct, I do this over and over and over again, I'm going to have solidly winning returns. So just just a way to look at the different trades. So that's basically what I wanted to get across today. Hopefully you got something out of this. Trying to explain how the pricing works and then bring it into the real world, show you what happens in the real world with real prices, real trades. In the live trade briefs, excuse me, not live trade briefs, the trading sessions that we have in the morning and the afternoon, we go over these a lot. When I'm in class, I'm very often going over iron condors, different styles of trades. I use expectancy in this type of analysis. So hopefully we'll be able to take a look at this in the live market. And so that pretty well wraps up the class itself today. So any questions? I'm going to open it up at this point, give you the chance to ask questions. I'll do my best to explain it. Hopefully I can make things clear. Alan, how do I decide if the implied volatility is too high? Well, it's a bit of a judgment call, but some of the things that you want to look at are whether or not the historical volatility in general of the stock justifies having the implied volatility so high. Remember, historical volatility and implied volatility are actually the same thing. What they're doing is they're telling you how much the stock price will move over 1 year, what one standard deviation movement up and down will be. If the historical volatility, and let me actually go back to the chart here. If the historical volatility is very, very low, and in this case the historical volatility is about 14%, and the implied volatility is at 35%, I know that in general, and this is not perfect, this is where your judgment needs to come in. In general, the way that the stock price is not going to change unless something significant comes along and changes it. Is there something that's going to happen that's going to change the way the price of the stock moves? Well, maybe there is. I don't know. But most of the time, there isn't. The big dramatic events that change the way prices move have been fairly frequent recently, but not so frequently that they justify having a 35% implied volatility. Remember, this number, implied volatility, 35%, and this number is basically telling you the same thing. They're two estimates of the same number. One estimate is based on what has happened with the price of the stock. That's historical volatility. The other estimate is what is built into the price of the options, and that's implied volatility. So if implied volatility is significantly higher than historical volatility, I generally consider that overpriced. Now, if it's high enough and I don't see a reason for it, then that means that I probably want to be looking at that as a short trade, a short volatility trade. Either credit spreads, legging into two different credit spreads to an iron condor, or just creating an iron condor. If the implied volatility is very low relative to the historical volatility, that usually creates a different opportunity for me. That's when I want to be long. I want to be long volatility, so that would be a straddle or a strangle, or maybe even just a straight a debit spread, or even a straight long option. Options pricing. Why do people describe 80% delta as a sweet spot when getting 100% delta would give you profit dollar for dollar with the movement of the stock price? Well, getting 100 delta is a pretty challenging thing to do. You basically got to have an option that's so far in the money that you're basically buying the stock itself. I would say, I'm not sure if I'd call 80% the sweet spot. I guess in some styles of trading it would make a lot of sense that it would be. I'd say that it's one of those things that's decreasing. The amount of money and effort that you put into getting that extra delta has a decreasing return. If I was to buy, let's say, a deep in the money long call, I'm getting a certain amount of leverage out of that. At 80% delta, the price of the option is going to be cheaper than going all the way into 100, 100 delta. And as a matter of fact, at 100 delta, I might as well just be buying the stock. So without completely understanding the concept of saying that 80% is the sweet spot, I'd say that's probably the answer right there. John, yeah, absolutely looking forward to getting the spreadsheet. The historical volatility measurement that I use is one called Rogers and Satchel. There's about 5 or 6 different historical volatility measurements. They all basically work off the same idea. It's the price movement, creating a probability model that says 1 standard deviation at 1 year. Rogers and Satchel, the only thing that they do differently is they basically calculate it using intraday prices as opposed to overnight prices, and they take out the gaps. Now, sometimes I can create a slightly lower historical volatility, but what it doesn't do is it's not susceptible to these massive high historical volatility numbers you get that don't take out the gaps. And the fact is that after a stock gaps, it doesn't mean that it's got a high probability of gapping the next day or the next day. It just means that it gapped that one day. It's very rare that you ever see a gap and then 3 days later see another gap. So that's the one I'm comfortable with. Has a slight tendency to be a bit low, but it seems to work a lot better than some of the others that have a horrible tendency of being way, way overinflated. Alan, is it okay to compare all past implied volatility and see what the most recent implied volatility is, and then say IV is low or high compared to the previous? Well, that's actually not a bad way of doing it. It doesn't give you the whole story, but it's nice to know where the implied volatility is in its own range. Just like historical volatility, implied volatility has its own ranges. A stock has a certain tendency to have a certain range of implied volatility. So you can actually create a channel and see whether or not the implied volatility is low in that channel or high in that channel. And that's a great way of looking at where the implied volatility itself can be. Now, if you're doing a trade that's basically long implied volatility, a long trade, that could be a really good way of analyzing it. Because for the most part, whenever you're doing a long trade, you're never holding it to the expiration. You're just holding it for a period of the life of the option. And what you just described works very well for that, because you're hoping that the implied volatility moves back up within its own range, and you make money off of that. If you're doing a short trade, though, what you're really looking for is to a certain extent, you don't even care what the implied volatility is after you enter the trade. All you want to know is that the actual price movement doesn't justify the implied volatility. So when you're dealing with a credit spread or an iron condor, you want to make sure that the price movement is not going to break your short strikes. And that's what's the most important thing. And to be honest, that has nothing to do with implied volatility. It's purely to do with price movement of the stock, and the better model for that is historical volatility and a little bit of judgment. If I've got an earnings announcement coming up in 1 week, I know that my historical volatility number is probably quite low compared to what might actually happen. So I need to use my own judgment to determine that the number should be significantly higher. The risks are higher. I may not want to get into an iron condor. But if I've got, like in this case right here, if I have a stock that has a historical volatility of 14%, and the market isn't really changing a lot, and let's just say we're in the middle of the doldrums in the summer, it's not likely that this price or that the stock price is going to move more than this 14% implies. So I can actually predict into the future that, let's be a little conservative, let's say 15, 16% forecast volatility. If the implied volatility is much higher than that, I can short that implied volatility and play it off against the actual price movement and hopefully make some money. Yeah, Bob, that is exactly it. This is something I see a lot, especially the straddles that we do. we're actually sometimes buying into a straddle or a strangle as we approach an earnings announcement with the expectation that the implied volatility is going to go up. But we're sometimes paying a lot for that, expecting that it's going to go up even further. Sometimes this reminds me of the housing market a couple of years ago, but which is kind of scary. But we're doing it in a very calculated way. If that doesn't pan out and the implied volatility drops, it can turn into a horrible trade. You can lose a lot of money on it. That's why you have to be very careful about it. And understanding how the implied volatility is going to move is a critical piece to that. To be honest, all of these examples I gave here are kind of cartoonish examples. They're exaggerations of real life. Nothing is ever quite so obvious as that. But hopefully they get you thinking about what to look for with the pricing of the options. Any other questions? Hey, the new people here, the people who are for the week session, is there any questions out of you? I'm seeing names that I recognize. I'd love to see some people who are fresh here and ask some questions because this is, we talk about stuff like this in the classes all the time, and a lot of what we go over is these exact examples. So raise your hand, toss some questions into the chat room, please, and I'd love to answer them for you. Anybody else? Awful quiet out there. I've either completely confused everybody or it was completely clear. Sure, Jose. Let me see here. If you want to run the numbers again, the symbol that you're looking at right here is RSX. Now, I don't want to give that out as a trade advice, but all of the things that I went through on these spreadsheets were live numbers. I literally pulled them directly from the market just before we got into this class. In the live trading labs, we get into live trade analysis. That's probably the better place for us to go over live numbers and walk through this stuff step by step. When I'm in the class, let me see here. Wednesday morning I'll be there, and Friday morning I'll be there, and we'll be looking at some different trades and going over some live numbers. And I'll be giving you my perspective on these, just like I gave you, during this class. Ed, yes, we can download the slides. I'm going to be handing these off to Doug after the class here. And yes, this is all archived, and you should be able to get a hold of the video from the archive. Doug Reagan will be able to sort that all out for you all. Jose, I didn't mean to kind of blow you off. I hope you understand that. I absolutely want to go over the live analysis. If we get into that right now, we'll be here for hours, and we've literally got 35 minutes left to the market before we close. Tomorrow, let's see here. Yeah, tomorrow morning we'll be looking at live stuff, and Friday morning we'll be looking at live stuff with some of the analysis that I do. Okay, the rest of the week we've got 2 more classes coming up. We're going to be going over creating a trade plan and an actual one that I think is really important. It's going to expand on what we just talked about a lot. It's a session on building an edge into your trades. And that's where we're going to really get into the decision-making process with implied volatility and historical volatility and lining up your trades to basically take the best advantage of the options market. So looking forward to talking about those. And Wednesday and Friday, I'll also be in the the live trade room, and we'll be going over some live trades. Hopefully find some profitable things to look at, some good trades. Oh, thanks. Thanks, Jerry. And by the way, I really like the fact that we've got some new people in here. We've always had a great group, and it's the people in the groups, the people in the trade room really make it interesting and exciting. Having some new faces is actually a really exciting thing for me, because I like to get the new ideas. I like to have people challenging me on stuff, and I think the people who've been here a long time can say that it's a pretty interactive group. We all work together to try to build this into a better a better trading group, and people bring things to the sessions all the time that I hadn't thought about, and really make them good. So the idea that we've got some new people coming in is great. Looking forward to seeing you. Is there any other questions? If not, I'm going to wrap things up. I'm going to get the slides and the Excel spreadsheets over to Doug. I'm going to give you a warning on the Excel spreadsheets. When you load them up, they're going to give you a warning about macros. This thing, just to make this stuff work, I had to put in a lot of VBA code, and those are the macros in it. I promise you there is no viruses, and I'm not trying to hijack anyone's computer. So just, if you could take that on faith, I'd appreciate it. The other thing is, I believe they work in Excel 2007, and I know that they work in Excel 2010. Regrettably, they do not work in anything else. They don't work in 2003, and they certainly don't work in Excel 2000. Just to make some of the calculations work in here, I put a lot of time and effort into some fairly serious programming, and that means it just doesn't translate well into other systems or old systems. So I'm sorry if that means that you can't use it. I'd really like to help everybody, but I'm not sure I can make a system that does. All right, everybody. Have a good day. I'm going to wrap up. We get 30 minutes left to the markets. I'm going to go close out some trades, and look forward to seeing you in the morning.